Which jobs does artificial intelligence eliminate first? Most people answer that question wrong. They picture a factory floor, assembly lines, forklifts, hard hats and steel-toed boots, blue collar. That answer just got publicly, measurably, expensively wrong. ServiceNow reported first quarter earnings on the 22nd of April. Revenue, $3.77 billion. Year-over-year growth, 22%. Beat analyst estimates on the top line. Beat on subscription revenue. Beat on remaining performance obligations. The stock dropped 15% in a single session. A company posts 22% revenue growth and loses $15 billion in market value overnight. That is not a miss, that is a message. The message is not about ServiceNow, the message is about you. This is where the advice sounds safe. AI replaces repetitive manual work. Protect your skills. Stay educated. White-collar jobs are harder to automate. You have heard some version of this for 3 years. It is a clean story, logical, reassuring. 3 facts say it is wrong. The safe answer is the expensive one. The first fact arrived on the 22nd of April at market close. ServiceNow makes enterprise workflow software. It helps companies automate tickets, HR requests, customer service routing. The platform processes over 80 billion workflows and 6.5 trillion transactions per year. Revenue grew 22%. Subscription revenue alone was $3.67 billion in one quarter. The stock still fell 15%. Investors are not punishing growth. They are pricing in a future where that growth requires fewer humans to build, sell, and maintain. ServiceNow's GAAP operating margin dropped to 13.5% from 14.5% a year ago. Part of that is integration costs from the Veza acquisition, which closed the 2nd of March, and deal-related expenses ahead of the $7.75 billion Armis acquisition that closed the 20th of April. But the larger signal is structural. When a software company grows revenue 22%, and the market erases more than 40% of its value year to date, the market is saying something specific. It is saying the product works, and the people who build the product are becoming optional. Your career has an immune system. It is fighting the wrong infection. You prepared for the factory floor threat, upskilled, stayed in an office, got a degree, built a career in software, finance, project management, data, analytics. The threat walked in through the office door. The iShares Expanded Tech Software ETF, ticker IGV, is down roughly 16% year to date according to iShares official data. The broader SaaS index has dropped almost 40% from its October peak. Meanwhile, the semiconductor ETF, the companies making the chips that power AI, is up over 43% in the same period. One side of technology is building the replacement. The other side is being replaced. 16% down, 43% up. Same industry. The second fact is a Goldman Sachs research note published the 6th of April. Economist Elsie Peng built a framework separating AI's 2 effects. On employment substitution, AI replaces the human outright. Augmentation, AI makes the human more productive, sometimes expanding hiring. The numbers. AI substitution eliminated approximately 25,000 jobs per month. Over the past year, augmentation added back about 9,000. Net loss, 16,000 jobs per month. That is not a projection, that is a count. 16,000 per month already happened. And the jobs being eliminated are not on the factory floor. They are in data entry, customer service, legal support, billing, claims processing, administrative coordination. These are office jobs, salaried jobs, jobs that require a degree and a commute and a laptop. Public data, published formulas, not personal advice. Your variables are your own. Verify before you act. But the category of worker absorbing the most displacement right now is not the one most people expect. According to layoffs tracker data compiled by Layoffs by Y, the tech sector recorded over 78,000 layoffs in the first quarter of 2026. Nearly half were attributed directly to AI replacing roles. That is not a recession pattern. Recessions cut costs across the board. This is targeted. 3 months, 78,000 half from AI. Think about a 32-year-old project coordinator in Indianapolis, making $67,000 a year, 4 years of experience. Uses ServiceNow at work every day to route it tickets and manage vendor onboarding workflows. Good at it, efficient, gets positive reviews. That person's employer just watched ServiceNow's AI product portfolio hit $1 billion run rate. The platform is learning to do the routing, the vendor onboarding, the ticket prioritization, not perfectly, but cheaper, and 24 hours a day. That is not a job performance problem, that is a math problem. And math does not negotiate. Pause. The third fact is what happens after. Goldman Sachs tracked over 20,000 individuals displaced by technology over 4 decades. The data shows a pattern. Workers displaced from technology disrupted roles take approximately 1 month longer to find new employment than workers displaced from stable roles. When they do find work, they suffer real earnings losses exceeding 3% immediately. 3% sounds small. Over 10 years, earnings for technology-displaced workers grow nearly 10 percentage points, less than for workers who were never displaced. 10 percentage points. That is not a gap, that is a different life. And it compounds. Delayed homeownership, delayed household formation, slower wealth accumulation. A 3% pay cut on day one becomes a structural downgrade. Over a decade, the project coordinator in Indianapolis finds a new role, different title, lower pay, fewer responsibilities that require the skills they spent 4 years building. The industry calls it occupational downgrading. The person living it calls it starting over. 3% today, 10 points over a decade, same person. Now here is where the standard narrative offers comfort. Technology creates more jobs than it destroys. That has been true historically. Goldman's own researchers acknowledge it. The augmentation effect added 9,000 jobs per month. New roles in AI infrastructure, data center operations, power systems. The creation is real. The problem is timing. The destruction is here. The creation is coming. And the gap between those two? The months or years a displaced worker spends retraining, searching, accepting a lower offer. That gap has a cost Goldman now quantifies. The gap is not temporary, it leaves a scar. The deeper problem is who absorbs the gap. Goldman's data shows the unemployment rate gap between entry-level workers, under 30, and experienced workers over 31, has widened sharply in occupations most exposed to AI substitution. The wage gap has widened by roughly 3.3 percentage points. Gen Z workers are disproportionately concentrated in exactly the roles. AI automates first, data entry, customer service, legal support, billing. The entry-level pipeline into white-collar careers is narrowing, not because the jobs disappeared, because AI got to them before the next class of workers did. A 24-year-old graduating into this market is not competing with other 24-year-olds. They are competing with a system that does not sleep, does not negotiate salary, and improves every quarter. The entry fee to white-collar work used to be a degree. Now the degree gets you to the door. The door is automated. This brings up the part nobody mentions at dinner. Your 401k. If you work in tech, or if your retirement portfolio is weighted toward the S&P 500, you own software stocks, you probably own ServiceNow, or Salesforce, down roughly 35% year to date. Or Intuit, the worst performer in the entire S&P 500 this year, down around 42%. The S&P 500 Software and Services Index is down roughly 20%. In 2026, according to S&P Global data, the total damage across software stocks has been estimated at $1.6 trillion by the Wall Street Journal. $1.6 trillion. One sector is funding AI development. Another sector is being devalued by it. If your retirement savings sit in a broad index fund, you are on both sides of that trade simultaneously. You are paying for the technology that is repricing your own labor market. That is not irony. That is structure. The real question this earnings season is not whether ServiceNow beat estimates. It did. Revenue grew 22%. The platform processes more transactions than ever. The AI product line is on pace for $1 billion in annual revenue. The real question is what 22% revenue growth means. When the market responds by erasing 15% of the company's value, it means the market believes the growth is real, and the workforce behind it is shrinking. It means revenue per employee is climbing. It means the same output requires fewer humans. It means the software sector is being asked to do to itself what it has been doing to every other industry for 20 years. Automate, optimize, reduce headcount, ship faster. Except now the headcount being reduced writes the software. February 2026. Anthropic launched a suite of AI tools designed to handle complex professional workflows, legal research, CRM management, analytics. Within a week, nearly $300 billion in software market value evaporated. According to Forbes, hedge funds had already shorted $24 billion in software stocks by early February. $300 billion one product launch 1 week. The advice you were given was not wrong in 2015. It was not wrong in 2020. Get educated, work in tech, stay in an office, upskill. The advice stopped being right in 2025. The Bureau of Labor Statistics still projects software developer employment to grow 17.9% between 2023 and 2033. That projection was published before the current wave of AI tools hit production, before Anthropic, before the SaaS wipeout, before Goldman put a number on net job losses. The BLS framework measures occupation categories. It does not yet measure what happens when the tasks inside a category get automated while the category name stays the same. Your job title survives. Your job description changes. Your leverage disappears. The national unemployment rate in March 2026 was 4.3%, according to the Bureau of Labor Statistics. That number looks stable. Inside it, the information sector and financial activities sector are shedding jobs. The overall rate masks a rotation. Blue-collar employment is holding. White-collar employment in AI-exposed roles is softening. The immune system is still fighting the factory threat. The infection is in the office. So here is the question you have to sit with. Not whether AI will take your job, that framing is already outdated. The question is whether AI will take enough of your job. The routine parts, the automatable parts, the parts that justify your salary. To change what your labor is worth, not next decade, this quarter, and whether the 10-year earnings scar Goldman measured in historical data is a warning from the past, or a description of what is already happening. The answer is not in a headline. It is in a spreadsheet you have not opened yet.